In this video, I'm going to be showing you the basic fundamentals of day trading. I'm not going to be showing you anything else other than what is day trading. As you can see on my screen here, we've got a chart, and this is what your average day trading chart would look like on this app called TradingView. All of my demonstrations are going to be made on TradingView purely for the purpose of easiness, and I like how it's laid out. Right, so let's jump right in and get started. From here, we'll go straight to a quick slideshow, a bit of boring slideshow talk to show the basic fundamentals of day trading. So, what is day trading? Technical definition for day trading is the buying and selling of financial instruments like stocks, forex, and crypto within the same trading day to capitalize on short-term price movements. Now, I'm going to say something to confuse you here a bit, just to make things simple in the long term. There's many types of trading. Day trading is what we're going to go through in this playlist or series, you could call it. But you've got spot trading, you've got futures trading, forward trading, options trading, swing trading. There's a big broad umbrella for trading the stock, forex, and crypto market. Now, with my demonstrations, I'm going to be using mainly Forex, which, if anyone doesn't know, Forex stands for the foreign exchange. And this is where you'll be trading between two prices. So we're going to be using the euro and the US dollar to begin with, and we're going to be trading between the euro and the US dollar. To make things in simple, day-to-day life terms, let's say you go on holiday from Germany to the USA. When you leave Germany, you're going to have euros in your pocket. So let's say you have 100 euros, and when you go to the USA, you can't use your euros as currency because they won't accept it. So you change that into US dollar. You pull out 100 euros in Germany, and you change it into dollars, which would equate to, let's call it $87. When you go to America, let's say you don't spend a single penny. You keep that $87 in your pocket, and when you come back to Germany, you give them back the money, and they'll give you 94 euros. So you've left with 100 euros, change that into $87 in America, and when you come back, with that 100 euros you used to begin with is now worth 92 euros. Now, in a perfect world, the bank wouldn't charge for the exchange rate, but they do, so let's ignore that. The rest of it has gone to market fluctuation. So how strong the US dollar is and how strong the euro is plays a big impact on how far apart each one is between each other. So if the euro is very strong and has a lot of market behind it, has a good economy, the housing market is booming, the euro is going to be a very strong currency. Whereas let's say in America there's just a market crash, there's been civil war or anything that would drop the US dollar, which could be anything from not harvesting enough wheat for that year, would devalue the US dollar. Everything that happens in the US would affect the US dollar. So that's the basics of trading Forex, the foreign exchange. Stocks and crypto are a bit different. We'll get into that in a separate video. But for this video, we'll focus on foreign exchange purely to keep everything intact. The key features of day trading is that there's no overnight positions. Meaning you open your trade at the beginning of the day. So UK banks open at 8 a.m. and they close at around 4, I believe it's 4:30, 4:30 in the afternoon. So that's your day. That's your typical trading day is what you could call it. So it's not from 12:01 a.m. till 11:59 p.m. It is the small window where the banks are open, which they're trading the currencies. So that's what overnight positions means. Reliance on volatility, that's once again a different video, but volatility in layman's terms and basic terms means how fast the price is moving up and down. We'll keep that thought at the moment. We'll move on to volatility in another video. Another key feature for day trading is that it's high risk, meaning you risk some money, and within that day you could either lose the money or make the money back or double it or make more. So that's the reason for high risk is that day trading is done in a small time period, meaning if the price doesn't go in your direction, you're out of your trade. Whereas in investing, which is over a longer period, if the price doesn't go in your direction for 2, 3, 4 months, 2 years, you're holding it for 10, 20 years, long-term investing, that's a blip in the scale. That's like 2 seconds on a day trading scale. So it really doesn't matter as much. It's a lot lower risk investing than day trading, which is comparatively high risk. And as it says there, there's the potential for high reward, which I'll get into later on. So the goals in day trading are to generate consistent profit, which is, any work you do, you're going to want to generate consistent profit, whether it's trading or working a 9 to 5. So you want to make continuous money. Over the month, you want to make money and not lose money. You want to manage risk effectively, meaning you risk the same amount every time, or you manage how much risk, exposure you'd like to do on any given trade. Use market volatility. Once again, that's for a separate video. I just thought I'd bring it up here to get you to think, and to maximize your ROI, which is your return on investment, which is, like anything, like buying a house. You buy it for £100,000, you sell it 10 years on for 140. You want to get as much out of your money as possible. Out of that 100,000 you begin with, you don't want to sell the house for 110 when the market's trading at 140. You want to squeeze as much of that as you can and get the full 140. So in simple terms, the goal in day trading is, you've probably heard this before, is to buy low, sell high. It's never that easy, but that's the easiest goal to write down, is just buy low, sell high. You'll see within maybe 5 minutes of trading realistically, which I'd advise you not to do at the moment, it's almost impossible. So let's hop back onto the chart to show you a more hands-on approach to this day trading. Okay, so like you saw at the beginning of the video, this is what your average trading view, the normal trading chart, would look like. If you zoom in here, you've got your green candles, your red candles. So let's zoom in quite close so we can see a candle. Let's use this red one here as an example. This red candle here, as you can see, this big body is what it's called. This is the candle body. This is the part that's shaded in and is filling the candle. So if it's red, it means it started at the top and the price went down to the bottom. So the body is where it started and where it finished. Then you have what are called wicks, and that's these two small, like candle wicks. I'm going to take my mouse off so you can see a bit better. These two sticks poking out of the body represent where the price has moved in between the open and the close of the candle. So the top of the candle is the open and the bottom of the candle is the close. You've got the two wicks either side, showing that during the movement of the price, during the 5 minutes that this candle was open, the price had gone up a little bit to this top of this wick here, to around that section there, and then it also had dropped all the way down to here, where it decided to close here. Same thing with this blue candle, the green candle, sorry. The candle opened at the bottom and closed at the top. In between, while it was open in that 5 minutes, you've got this wick here and a very small wick at the top. And that's where the candles moved in between the 5 minutes. If we go to, let's zoom out a little bit and move over to a live candle, you can see that in action and see that actually, here we go. So see this candle here, it's not the best example. There you go. So that's created two wicks either side, quite long, and a small body. So in the 5 minutes, the candle went down, up, and decided to close close to the middle. As you can see on this live candle here, right here, we've got 4 minutes on this right hand side. You can see 4, you can ignore the big number above. At the moment, you've got 4 minutes and 38 seconds remaining of this candle to be open. As you saw just previously, the candle had gone green and it's now gone red again. So see, this now left a wick behind showing I've been there before, I've now come down to here. So that's the basic understanding of candles. I'm not going to go too far into candlestick patterns or algorithms just yet. We'll leave that for once again for another video. This is just basic what is day trading. So let's zoom out a little bit and move to the back where I've set some examples of some trades. These aren't trades I've taken, these are trades I've just placed as examples for this video. So I've written here SL and TP. You're going to see this a lot dotted about in my videos. SL stands for stop loss. If I add it here, SL stands for stop loss, and that's where your hard stop is on where the price cannot go above. So if you see this line here, so you've now got this line here. If the price had come up to this line, your trade would have stopped out or cancelled. So this means you've lost the trade. TP stands for take profit. Let me write that down as well. take profit. To make things easier for you, every abbreviation I've written down, I'll pop it in the description below. So TP stands for take profit, and that's where your, as it says, the profit has been taken. So here on this, where this green chart is, the profit got taken there. So that's where you want your price to go, so that you can leave the trade and have no risk. Once the price has hit there, you've taken your money out of the trade and you've come away with a win. Ideally would be this section here, and there you go. So that's that. You've entered the trade on this white line here, which is your entry, which is on this green line here. So let's change this to white. There you go. So that white line is your entry. Let's change this to red. There we go. So that red line there is your stop loss, and the green line down there is your take profit. So that's what an ideal trade would look like, is you enter the trade and it barely goes into your stop loss, and hence you take profit. Let's do this one as an example. Here you can see I wanted the price to go up, so I started here. I put my stop loss down here. There I put my entry was dead center there. I'll change that to white, and my take profit was up here. Now this is something you will see when you trade. You entered the price and it went straight in your direction, almost hit your take profit and bounced away. It's never going to move in a straight direct line. It's always going to have, a zigzag pattern to it. So follow the chart up. You can see it went up, went down, carried up to this point here, just below your take profit zone, which is this section here, and dropped back down and hit your stop loss. So this is what I mentioned earlier about having a good risk management scenario in your head. This is where the price is going to go and I'm going to leave, and this is where the price is going to go and I'm going to take the profit. Let's start another section here. Let's call it this one here. So I'm going to set my risk to, let's move that to there. So you've got here let's make this a 1 to 2, same thing, just to keep things easy. Let's call that 1 to 2. So here you've got a 1 to 2 trade. That's hit. You see here, your take profit has been reached, so you've cleared the trade. However, in the middle of the trade, you've spent 13.5 hours later, your trade hit. In between that, the price has gone down, come up. You think you're good here, it's gone back down, it's come back up, it's tricked you again. You've gone through such a range of emotions that you have to control, which is, once again, I'm going to teach you in a different episode, that you're unsure whether you made the right decision to begin with or not. I'm going to say it now so you can write it down. If you've looked at the charts correctly, if you've made your assumption correctly and placed the trade, even if it's 2 days later, do not cancel the trade without good reason. As in, don't go, oh, I'm not sure if that was the right decision to make, I'm going to leave. Now, further in other episodes, I'll show you good reasons to leave trades and good reasons to enter. Same concept. But for this one, just write it down. I will not leave a trade unless I have a good reason. And I will not enter a trade unless I have good reason. So that will be it for today. That's the basics of day trading. So I'd like to thank you very much for listening today. Hit the like and subscribe button. That would help me out very much. I appreciate it. Like always, I'll see you tomorrow.